Mark Matthew joins us. Let's say hello and good morning to him. Mark, good to have you on ET Now. Thank you for joining us. So, Mark, what is your big call for 2025?
My big call is at some point during this year, there will be a sizable correction in the stock market, I would say in the magnitude of at least 20%, but I can't tell you when that will be. That, however, I'm quite sure will happen at some point this year.
The move into US dollar, do you think that is getting slightly crowded and everyone is on the same side of the board? Because emerging markets, including China, which are cheap and which have a case why flows should be coming back into emerging markets, flows are moving away.
I do agree that the dollar is a big issue, and it's one of the reasons why Indian market has been quite soft recently, because foreigners have been selling. Now, fundamentally, the dollar is extremely overvalued. It's as expensive as it's ever been. But on the other side of the coin, there's tremendous amount of uncertainty about the rate of economic growth and inflation in the United States because of the incoming Trump administration. And as Fed Chair Jerome Powell said in his Q&A with the press last month, it's like walking into a dark room that's got lots of furniture in it, or driving a car on a dark and foggy night. You have to move very slowly. So on the one hand, it's expensive. On the other hand, I think that rates are going to stay high. If we're lucky, we get one more rate cut from the US, but even that, I would say the odds are 50-50.
Interesting. But Mark, what leads you to believe that there could be that impending correction in the markets?
Yes, well, the reason is, number one, they've done very well over the last 2 years, and so they're no longer cheap. The US is on around 27 times its last year's earnings. That is, by historic standards, on the pricey side. The long-term PE ratio is around 20 times. Now, the good news is there is earnings growth. Earnings growth will be in the mid-teens, the consensus thinks, for the US this year and next year. I have no reason to doubt that, but it is something that is already anticipated. And even if you factor that in, you're still looking at 22 times 2 years from now. It's not wildly expensive, but I certainly wouldn't call it value. So if you add the fact that the market has done so well with the fact that rates are probably going to stay high, I'm not saying everything will go down, but I do think some of the things that have gone up a lot can correct. And those are the things that could take the S&P 500 index down.
So if rates they stay higher and if money will gravitate towards dollar, do you think that the outperformance in US tech stocks will also stay?
No, I don't think they'll outperform. They'll perform in line at best. I think the market is starting to realize that a little like the internet back in the 1990s, it is happening. Artificial intelligence is happening. It's for real. It'll have a hugely positive impact on efficiency, productivity, etc. Many great things will be invented. But back in the 90s, the way people were playing the internet was through companies like Dell or Qualcomm or Oracle or Cisco. We know those were not the really big long-term winners in the internet. Those were companies that barely existed back then, like Google, or in some cases they didn't exist at all, like Facebook. And so I think today it's the same. People are starting to realize those hyperscaler, mega cap, Magnificent Seven companies are not necessarily going to be the big winners in AI. And just to give you a small example, Google, of course, they have many engines of growth, but the biggest one is their search engine. That is coming under big pressure from alternatives like, for example, Perplexity, many other artificial intelligence chat boxes are producing superior results to Google search and with much less clutter, much less advertising.
Interesting. So what does that really spell, Mark, for the Indian IT services providers? And do you really think they can ride on to the AI wave and get a chunk of the outsourcing business?
Honestly, I can't answer that. I think that probably yes, but as I said, the companies that will really do well in this are probably little tiny companies now, like I mentioned, Perplexity, or they're not even listed. Well, Perplexity is not listed, I should add, but yeah, I imagine India will, in some way, directly or indirectly, be a beneficiary. Now, for the economy as a whole, there will be tremendous progress made because of artificial intelligence. In fact, we all are obsessing about the technology sector, but I suspect the biggest winner in AI will be the healthcare sector. And anyway, that's a totally different conversation.
So Mark, cash is giving 4% return. Do you think it's a matter of time someone would say that 4% is not bad? It's been a good level for financial. It's been a good patch for gold, Bitcoin, US tech stocks. So do you think somewhere it's time to pivot back into cash?
Yes, the problem is the situation we're in now is a very tricky one because sometimes at the end of a bull market, the best returns are at the end of the bull market. And so I wouldn't want to become extremely bearish right now because we don't have all the indicators to confirm that a top is in. But there's more and more that are coming in to suggest that. So we have not reduced our own risk in our portfolios, but we're suspecting that at some point this year there will be a reason to do so. And so for now, no, but at some point, yes, there will be a time to move into cash.
Mark, so for the preference in terms of emerging market, China is cheap, but India is where the growth is. When do you think this interplay will be more and more evident? Because for the first half of last year, it was India. Second half of the last year was China. What do you think would be the dominant theme within emerging markets this year?
My hunch, it's a theme that nobody really is talking about, which is that the Chinese property market will stop going down. And I think that's going to happen. And if it does, it'll be a tremendous surprise because nobody's expecting it to. Everybody thinks that Chinese property prices are just in an endless downward spiral, but volumes actually have started picking up, and prices in the tier 1 cities have started rising. So to my mind, that would be the major thing because 80% of Chinese household wealth is in residential real estate. And if prices there bottom, even start to rise a little bit, that'll have a tremendous impact on their consumer confidence, and I would think in turn business confidence.
Interesting. Mark, what about Bitcoin? Because that was being pegged as a more risk-on kind of trade. But where do you actually see the cryptos headed in this year?
It's a tough call, but I mean, I actually can't hazard a guess. All I can say is that they've gone up a lot. I can't hazard a guess on that. The problem is the valuation. It's hard to put a value on them. Up until now, the idea has been that there's a limited supply, but potentially endless demand. But I'd rather not answer because I don't have a good answer. I'm sorry.
Fair point. All of us are puzzling as to what really led to that kind of move in any case. But where does that leave gold, considering you are, foreseeing an impending correction in the equity markets? You talked about the Chinese real estate market. What about gold? Do you see safe haven, move towards that asset class?
Well, I think there's two main dynamics with gold. The first is geopolitics, and the second is the emerging market central banks and households in emerging markets who have been pretty consistent buyers of gold for the last few years. Geopolitics, I don't know what to say. I mean, on the one hand, I think that Donald Trump will try to create a situation where there's a ceasefire in Ukraine, and I doubt the Russians would accept that if it was not contingent on unfreezing Russian financial assets that have been frozen. That would be negative for gold. But I also hear that Putin's in no hurry to agree to a ceasefire because the war seems to be moving the way his way, and he is looking for actual regime change in Ukraine, not just the parts of the country that are under his control right now. So geopolitics, I think it's sort of too hazy to be able to see what the picture is there, but the demand from emerging market central banks and households in emerging markets, that I feel is pretty constant for gold. And so I think there's a structural case for gold continuing to go up because of those two big buyers.
All right. So, Mark, just to wrap it up with one final point, this entire adjustment, which is called as the Welcome Back Trump rally, whether it is in gold, whether it is in Bitcoin, whether it is in global energy stocks, do you see a shelf life in this?
I do, actually. I think that on balance, what it means is a higher rate of GDP growth in the United States. And generally, we should construe that as a positive. But what I think it probably means is a broadening out of the market away from this highly concentrated market of the last 2 years in mega cap technology stocks into more cyclical sectors that would benefit from a stronger economy, like industrials, like financials, and I would say also mid caps. We don't really like small caps in America because they're about half of them are unprofitable, but the mid-cap space is very big and has some extremely good companies in it. So I would say the Trump trade is more in those areas than mega-cap tech.
Mark, great to have you on the show. Thank you so much for your time today.
If you like this video, then like, share and subscribe to ET Now.